Everyone, and let me welcome you on behalf of LPEA to this webinar. Today's focus is ESG with linking the activity of GPs coming from the US and their activity in the European Union. So I would like to take the opportunity to thank our speakers, Adam and Kerry and Ed from K&L Gates, as well as Mark from Apex Group and Katie from Holtara. So actually, enough of me. Without further ado, I will pass on to Adam that can start the webinar and deep dive in the content. Thank you.
Thank you. Thank you, Johan. So a warm welcome to everyone joining us today. I appreciate there are professionals from different time zones in here. So thank you for making some time available to attend our webinar, which we intend to make as insightful and concise as possible. So I'm Adam Pascalidis, an associate of K&L Gates in Luxembourg. With a 15-year history, our core asset management and investment funds practice includes one of the world's largest and experienced investment management legal teams. Since 2021, K&L Gates is present in Luxembourg with a particular focus on advising asset managers along the life cycle of their investment structure. So in terms of ESG, I have expressed a particular interest in assisting clients design their ESG profile. Thus, based on experiences as well as academic certification, I'm the first point of contact for ESG matters in Luxembourg. Today, I'm delighted to be moderating this panel of professionals, each of them having particular ESG experience to offer to the table tonight. Ed Dartley is a seasoned partner at K&L Gates with considerable exposure in the AIF industry, while Kerry Rimmer is of counsel in K&L Gates Asset Management Investment Funds Practice Group and one of the K&L Gates leading specialists in ESG. I believe that I speak for all of us here that representing K&L Gates at this panel when I say that exchanging views with Mark van Rijk-Volksel, I believe I say the name correctly, Mark, Head of Sales for International Solutions of Apex Group, and Katie Bloom, Principal of the US Holtara team, is a delight in itself. And I'm certain that the same will be shared by all attendees as you will watch this webinar. However, it's more of a pleasure than an obligation to thank LPEA, the Luxembourg Private Equity and Venture Capital Association, our co-host at this event, for having worked together with us so that this webinar becomes a success. A big thanks to everyone at LPEA. Mark, I believe a brief introduction of Apex Group would not only be due, but also helpful at this point. So would you agree?
Yeah, thank you so much, Adam. And also a big thank you to the LPEA, of course. Well, my name is Mark van Rijk-Volksel. I'm from the Netherlands, but based here in New York, work for the Apex Group. I've been here for the past 9 years, assisting North American-based fund managers with their international servicing needs. Well, being from the Netherlands, I'm obviously a big fan of cycling, so I use a city bike here in New York every day, make sure I exercise and help a tiny bit with keeping the world the beautiful place it is. But for those who don't know a little bit about Apex, so Apex is a global fund service provider. We have presence in more than 50 countries with 14,000 employees, of which about 1,000 in North America and approximately 4,000 in Europe. So I think we definitely have the experience to talk to this topic. What we do is we focus especially on fund managers and the portfolios accompanying them, assisting them through the whole life cycle of their funds. This means assisting with fund distribution and connecting GPs and LPs, fund administration and investor reporting services for closed-ended funds and open-ended funds, fund SPV services, including opening bank accounts, as well as more specialized services, including helping US managers dealing with for example, MiFID and AIFMD. But more importantly, the topic of today is the regulation on ESG sustainability, including SFDR, SDR, and the upcoming CSRD. Well, this brings me to Holtara. Holtara is our ESG and sustainability brand within Apex Group. We have more than 150 employees globally dedicated to ESG and sustainability with teams in the US, Europe, and India. Holtara offers a very unique combination in the sense that we do advisory consultancy solutions for LPs, GPs, and their portfolio companies, but we also assist with data collection and reporting of the data thereof, and we help GPs in the portfolio companies. we will make sure that following the webinar, everyone receives information and presentations on our company, Apex and Holtara. But I would really like to give the floor to Katie, who is leading the team here in New York of Holtara. Katie, over to you.
Yes, thanks, Mark. Happy to quickly introduce myself, Katie Bloom. I come from Holtara, as mentioned, the principal for our US team in the broader Americas, but sit in New York myself, and come from a background of sustainability, finance, and accounting as a CPA by trade. Realized very quickly that I was looking to make more impact in my career and made my way over into the ESG and sustainability space, first in the SaaS world and now in the combined platform and advisory offering space. I'm very excited to be here and part of the conversation today.
So maybe Ed and Kerry, a brief introduction or some thoughts before we begin.
Sure, Kerry.
Sure. And I'll echo Adam's sentiments about being happy to be here and participating with everyone today. I'm Kerry Reamer, and as Adam noted, I'm of counsel in the Asset Management and Investment Funds group. I sit in New York, although today I happen to be in Boston for a firm event. And I work primarily with SEC-registered investment advisors, as well as SEC-registered funds, so mutual funds, interval funds, closed-end hedge funds, and ETFs. And I work with ESG in terms of advisors that are utilizing ESG strategies as part of their investment approach, funds that utilize the strategies, and so forth. It just kind of like rolls into part of my practice group. Prior to joining K&L Gates, I was at the SEC and JP Morgan, and previously law firms before that.
Great. And I'm Ed Dartley. I'm a partner with the Asset Management Investment Funds Group here in New York, working primarily with private fund managers in a variety of different stages of their life cycle, oftentimes mid-market emerging managers. And one of the things that we are increasingly working with managers on that you'll hear about today is accessing other markets, in this case, the EU, for fundraising. And we work with those types of clients very regularly, both within the EU and outside the EU. And as a firm, we are roughly 2,000 lawyers, 160 asset management lawyers across the platform, and in 48 offices, and including, of course, Luxembourg and New York. So very happy to be here today.
All right. So I'll invite everyone to join us and delve into the ESG world. So understanding the ESG landscapes in the US and the EU, as I'm sure that most of the people here know and maybe struggle with a little, is the key regulation for ESG in Europe is SFDR. As we will discuss for this webinar, there are more and more investors that are interested in investing in Article 8 products, which certainly gives market a tune. However, how is this actually perceived, and more importantly, how can this be combined in a parallel structure when it comes to investment funds, both in the US and the EU? This question was actually the inaugural spark of this webinar, and this is where we are here. So I'll address this first question to Kerry. What are the key differences and convergences between the regulatory approaches in the US and the EU, and how might those impact advisors doing business in both the US and the EU, Kerry?
Sure, Adam. So it's probably easiest to start with what's similar versus what's different, right? So maybe the one thing that's similar is that I think both the EU and the US have the same approach. Pretty much all regions across the globe will have the same approach. You have to do what you say and say what you do. And I think that tenet holds true both in the US and the EU and pretty much any other regulatory regime. Aside from that, how the regions actually encompass that in terms of regulation is totally different. So now in the US, there's no ESG specific rule or regulation that at a federal level has been adopted. Some states either have adopted or considering adopting ESG specific reporting and disclosure regimes, but it's not quite clear the extent those are actually going to touch advisors or funds. But on a federal level, the SEC 2 years ago proposed ESG specific rules for advisors and SEC registered funds, so mutual funds, ETFs, so forth. As of now, there's been no movement with that. While we anticipated maybe seeing something the end of last year, even earlier this year, doesn't seem like that's going to be likely for some time. The SEC did adopt rules for operating companies relating to climate risk-related disclosures. And then the industry kind of erupted in litigation, and the SEC actually self-imposed a stay on its own rule, I think pending the outcome of some of this litigation. So that's kind of what's going on with the SEC right now in US products and US registered advisors. On the flip side, you then have some US advisors that want to do business or are doing business in the EU that now need to comply or have been complying with SFDR, as well as some other regulations, taxonomy and so forth. And so right away, you have a bit of a disconnect. And I think this is more of an issue for advisors that maybe want to have one product or one strategy and market it both in the US and the EU. So advisors there are now going to have to comply with respect to that single product. They have to comply with the SFDR and other regulations that apply to that product and to the advisor doing business in the EU, whereas those requirements don't apply to their business in the US. So I think, and we can talk about this later, but I think there's a bit of tension there. Whereas advisors are going to have to think, do they going to have two funds with the same strategy? Are they going to have two different strategies? One for one region, one for the other, or are they going to apply the strict requirements from the SFDR across their business in both regions?
Yeah, I think what I'd add to that is that within the United States, the fundraising environment, as we all know, has been challenging over the last 1.5 to 2 years. And what makes it more challenging for a fund manager that wants to incorporate ESG considerations either into its strategy or into its marketing of its fund is that the United States right now, as Kerry had alluded to, is a patchwork. There are states that encourage ESG, and there are states that discourage ESG. Now we're talking about government pension funds and municipal entities that will invest in funds. So it's not every type of investor in the U.S. that is subject to state mandates, but you have a patchwork. And you also have a political overlay with respect to the current environment, especially in this year's presidential election year, where ESG is a lightning rod. So you have a situation in which some managers need to navigate within their home turf to begin with and come up with a pathway, which is not always easy. Because in this fundraising environment, you're looking to try to, for as wide an audience as possible. When you add to that the overlay of thinking about accessing the EU, that raises some of the considerations that Kerry was talking about, and from a very practical matter, requires founders and key stakeholders to be making decisions about how they want to approach attacking the European markets. And I know, Adam, you've got experience with this, and I think have a few insights on that as well.
And one thing to note, if I might, not to cut you off there, Adam, but going back to the US for a second, even though there's no specific ESG regulation, there are existing rules, disclosure requirements that would apply to ESG. So for example, we have the anti-fraud rules. We also have, for registered funds, there's forms that, it lists all the requirements they need to comply with in terms of, and same goes for advisors with their Form ADV. They need to disclose all of their investment strategies. So advisors and funds still do have, some framework that they need to comply with in terms of disclosure and reporting, but there's nothing specifically to ESG. So, it's a conflict between the two regions, because just in terms of how you're actually going to think about doing your business, to Ed's point, it's already difficult enough in this environment. So figuring out how you're going to straddle both areas is something that advisors are going to need to consider.
Yeah, well, when it comes to the EU regulation system and framework, of course, we're trying to firstly explain to the potential clients what are the duties under the EU framework, and of course, it's the compliance with the CFDR and all the regulatory compliance associated with that. However, we also try to advise them how to structure their products so they are compliant with the EU regulatory system, as well as being appealing to the US markets and the US investors. So this will be discussed, of course, later in this webinar. However, this is the main concern we are faced with, but we are happy to help clients. I think we are quite successful to meet the needs of our clients. So I think this will be a very nice bridge to the next talking point regarding the ESG strategies and the monitoring and the ESG strategies, the policies as mentioned by Kerry. So I'll address the second question to Katie Bloom from Holtara. So what do you see as the most frequent strategies? How do you recommend for firms seeking to implement robust ESG policies that effectively address the challenges associated with transatlantic fundraising and investments? Katie, how do you advise your clients to design their strategies?
Yeah, so it's a great question. And I think a lot of it comes down to really understanding the so what of these policies, right? Successful implementation and even integration of ESG at large into these organizations, investment processes, and portfolio management really requires internal buy-in and awareness across the entire organization, not just at the leadership level, not at the fund management level, so on and so forth. It's really looking at how these policies are going to affect the roles and responsibilities of all individuals in the organization that we really encourage our clients to work towards, because that's really where you see the action take place. And I think it's important to recognize the difference in synergy between the policies and procedures that then support and action those policies that really require development, definement, and integration in the organizations to ensure that once we define these robust ESG policies that are supporting a lot of these nuances and challenges, that they actually do something and they mean something within the organization. So that's a lot of where Holtara and the likes of any, let's say, consulting or advisory firm would come into play, is really making sure that there's action driven towards these policies. There's, for lack of a better word, compliance with these policies, and they're truly making an impact and not just, let's say, check the box effort regarding what you could do and how you could best associate with those requirements.
Understood. Ed, your input in this question?
Well, I think it's going to be it's important for U.S. managers to assess both their business, the way they operate, their investor base, and their target market, both in the U.S. and the EU, and have a serious assessment as to how, from the perspective of ESG and the regulatory regime in Europe, how that can work for them to access the EU markets versus what they need to do in the US. And it's going to vary depending upon the culture and the strategy of the manager. As an example, there are private credit fund managers that have a sustainability and ESG focus. And for those managers, the decision is not only looking from the perspective of, the potential investments that they're making and having a clear set of sort of policies and guidelines and parameters for when they're diligencing investments, but also with respect to execution. And for private credit fund managers that have a sustainability or an ESG focus, it also includes, for instance, steps that they're going to require as a lender of the borrower for complying with ESG and sustainability factors. To Kerry's point, making sure that the portfolio investments are doing what they say and saying what they do. And that can come in the form of, for instance, covenants that govern, in the credit facility with specific metrics with respect to ESG and sustainability, just as one example. So I think those are the kinds of considerations that, from an organizational standpoint and a strategy standpoint, you need to be thinking about in terms of implementing the, robust ESG policies that will resonate with a target market in the EU.
Mm-hmm. I think building on Ed's point there, it's also important to note exactly what we spoke to in the first section, where there's a lot of change in this environment, and it's constant, and it's certainly not slowing down anytime soon. So policies tend to remain fairly stagnant if there's no true merit in approach or consistency relative how often or frequently they're going to be evaluated and updated. So it's certainly important to make sure that these are moving and evolving documents that are looking to understand if laws and regulations change over time and to what extent, what types of policies and procedures are going to be in place to monitor, identify those changes or additions, and then act and implement them. So there's a lot of fluidity that comes to this as well, where it's one thing to define the policies, but it's another to make sure that, again, they're evolving with the space, they're allowing for change and not necessarily hindering any process or, say, additions, differences in the policy procedures and reporting that's going to be required to really stay on top of these evolving landscapes.
Understood. So, Kerry, when it comes to advising a client in designing or implementing an ESG policy, what are the specific? Are there any specific considerations or best practices that the GP should keep in mind when developing these ESG policies so that they ensure compliance with both US practices and EU regulations?
Right. Well, I think that's one of the questions to be asking. So are you going to have one compliance program or two? In the US, you don't have to have, and I don't think in the EU yet, I don't think you have to have a specific ESG compliance program. You might be expected to have a person designated as administering anything related to ESG, but you don't have to have a separate compliance program. In the US, a lot of times, like, you can just build your ESG related strategies and approaches or anything related to ESG into your existing compliance policies and procedures. So I think the first question is, do you want to have two parallel programs, one that applies to your EU business and one that applies to US? Or are you going to take, for each particular policy and procedure, the stricter of the two regulatory regimes and apply them across both parts of the business? And if you're doing that, you're going to constantly have to update for both, even though a policy might be much stricter than it needs to be to capture any changes that are made in one region. So I think that's the first step. You're going to have one, you're going to have two. How are you going to administer it? Are you going to have a particular officer? Are you going to have another member? Are you going to have an ESG committee overseeing everything? The other thing is monitoring any changes, and not just in terms of formal rules, but any enforcement actions, any other guidance that might be informal. How are you going to track that? And how are you going to then apply it? Or is it going to be applied across the board or just to the region or the clients that it actually applies to? Second thing, training, making sure that everyone's up to speed on any changes made to the policies, making sure that marketing team is in touch with portfolio manager team, making sure that the portfolio manager teams are actually sticking to any prescribed percentage limits that you've established for the ESG program that you're utilizing, making sure that your materials are constantly being monitored, tested, updated, to the extent that you're getting information from rating providers, ESG rating providers. Are you verifying them at all? Are these credible providers? Now there's been activity in the UK and EU to have some sort of authorization required for ESG data providers. There is no such thing in the US, but to the extent that you're getting information from third parties, really trying to do your diligence on those third parties to make sure that the information is reliable. So those are some of the things I think you're going to have to think about. But to Katie's point, it's true that monitoring and updating is going to be that in itself is a task, because there's always things going on and always things changing.
One of the things that I think is at the core of what a manager needs to be thinking about is what specifically does ESG mean for you as a manager and for your strategy? Because even though we've made some progress in terms of identifying the fact that ESG historically has been kind of a loose definition and concept. I think we've come some way in refining what it means, how it's defined in the markets, depending upon, you know, specific parameters. But really, for your strategy, what does that mean? And what I do when talking with managers is, you know, take examples of your last couple of investments and articulate how ESG was factored into. What is ESG for your strategy, and how was that factored into both in the diligence and the execution, and then the portfolio management phase of what you're doing?
Understood. Well, in the EU legal framework, and then when it comes to SFDR, although there is no specific requirements to have an ESG policy, as Kerry has already mentioned, the thing is there are some provisions, especially the ones require website disclosures, which in some way can imply that it would be better if you have like a universal ESG policy that applies to every product that you market, than like having different and confusing a bit disclosures specifically to each product. So in any case, when it comes to ESG policy, it's not, you have to pay particular attention to the binding features of this policy, because those binding features will appear in the disclosures and should be followed and met. So when it comes to, for example, to opting for an Article 8 qualification, you have to disclose some binding feature of the investment strategy, and this should be followed. And more importantly, there is a certain asset allocation between environmental and social characteristics and other investments, and this allocation should be followed strictly. In that case, in this, to help the investment managers and legal advisors and investment advisors, the CSSF has already published a frequently asked document, which is certainly useful as a guide. However, there are still open points that need to be considered. Of course, keeping an eye in future developments in the SFDR and the entire ecosystem of sustainability-related regulations in the EU, as well as the second wave of regulations that are relevant, should also be helpful. However, there are still a lot of points to address, and of course, we at the K&L Gates Luxembourg will try to address each and every client in their specific context and investor environment. So yeah, I'll go to the next question, and I think it would be best to a very frequent concern that we face when it comes to advising clients, and we'll try to help them with that as well by recommending some providers, is the monitoring of ESG performance. So including the use of ratings, methodologies, and measurements. Katie, would you be so kind to take the lead on this? Thank you.
Yeah, no, it's a tricky space, right? And it kind of comes back to what I was saying in terms of the policy. It's one thing to make a policy, it's another to action it and really follow and monitor it. And the same goes for ESG data and reporting at large, right? It's not a one-time effort. It's a continuous effort that's constantly evolving, which makes measurement and tracking that much more difficult, right? It's somewhat of a moving target that you're having to redefine constantly in order to stay up to speed. And what's important to recognize in that is that there's not one single factor that really determines the success of an ESG initiative or reporting effort. It really comes down to, and I love what Ed said in terms of understanding and defining what ESG means to each organization, because I think when you can root performance and measurement in that regard, it makes it that much easier for you to kind of parse out the noise and the weeds that we see in the market relative to all of the different definitions of ESG and these standards, right? As long as you can build the confidence and rigor in terms of your definition, certainly aligning to these standards and providing the metrics in accordance. But again, if there's decisions that need to be made relative an interpretation or a data proxy point, so on and so forth, having that, again, understanding of what ESG means to you allows you to root your response or your decision in a consistent manner. I think there's both the quantitative and qualitative indicators that need to be used when it comes to measurement. And a lot of this, again, comes down to customizing the approach. think it's easy to fall into the ways of groupthink in terms of how to measure performance, especially across the markets, be it geographical, industry specific, so on and so forth. But it really requires customization for all of what we're mentioning today in terms of, again, certain state presence or requirements relative global investment, where it is you're operating, so on and so forth. So I think it's great to look to industry specific frameworks like, let's say, SASB, the GRI, GHGP, PCAF, so on and so forth, to really provide that layer of understanding as to what relevant metrics are for your business, how to go about calculating them, providing the guidance around where you might need to disclose any, say, deviations or differences in terms of how you're calculating and reporting. And they're really used to include parameters that go beyond just the true metric of, let's say, carbon, but your employee compensation efforts, diversity of your board, so on and so forth. It really does span the E, the S, and the G. So it requires a few different, say, frameworks to get that done. Say, aside from gathering your data and making sure that you're looking to the various different reports, be it your financial, suppliers, industry benchmarks, so on and so forth, really comes down to understanding your organization, your trends in terms of, let's say, market performance, strengths, weaknesses, so on and so forth, and allowing you to understand not only where you are today, but how you want to present that in the story you can tell to the market, and where you're going to have to decide between what goes to public reporting and what does not, especially on the private side. In the US, there's certainly a lot of different, again, frameworks that are voluntary relative to these required reporting parameters, be it SFDR and CSRD. So there's a lot of noise to, again, work around in terms of what you are or not going to report and what's required for compliance and what is not. So it really takes, again, that fulsome understanding of defined performance. What does good look like for your organization? How does that relate to these different framework standards and regulatory requirements, so on and so forth? And then defining those tools that you're going to use to measure. And as Carrie was mentioning, in terms of ESG ratings, that's a little bit of an interesting one relative to the fact that, again, they are great, don't get me wrong, but there's a lot of differentiation in terms of how they're perceived, what it is that they're using in terms of underlying methodology to create those ratings or grades, so on and so forth. So they certainly are a piece of the puzzle, but not the full wholesome picture. So looking to, again, ESG audits and assurance performance relative, trying to provide rigor around that data and instill confidence and trust in the reporting measures. And then even questionnaires and surveys. I find that's something that really doesn't get spoken about too often or nearly enough, relative engaging your broader stakeholder base to understand what their expectation of you is in terms of ESG and what they're looking for relative, again, some of the external communication, but also internal operation.
Adam, could I just tack on one thing? Going back to a bit ago where we were talking about defining ESG, one point I just want to make is the advisor itself should be defining ESG for the entire advisor. It's not portfolio manager by portfolio manager. So I think if you're actually going to, if you're going to define these things and have an approach, it needs to be uniform across the shop. And it should really be spelled out somewhere and consistent with everything that you're disclosing in your document. So I think it's a good point. I just wanted to point that out, that it can't kind of be like one day it'll be this and then one day it'll be this. There has to kind of be, I mean, it can evolve over time, but it should be across the entire advisor.
So back to you, Carrie, again. So when it comes to ESG strategies, there are certain risks associated with every strategy, as everyone knows. So what do you see as the risk that most GPs prioritize, and is there a way for this risk to be mitigated? And in general, how different is the risk management exercise between the US and the EU when it comes to investment managers?
Well, I think one of the risks is basically just compliance risk, and regulatory risk. I think anytime you are applying any sort of screen, whether it be a positive screen or negative screen to your investments, you're excluding other investment opportunities. There's certainly, so there's like the business, like investment risks associated with ESG. But I think in terms of regulatory and business risk, not being able to satisfy investors. But then at the same time, you try to come up with an ESG related strategy because you have investors who want it, but you might not be set up for it, or it might not really be true to your investment approach and your investment philosophy. So I think you really want to figure out, are you, what kind of advisor are you? Is this the sort of thing that you really can encompass? and then figure out a way of doing it so it makes sense. Like, especially for smaller advisors, they might not have the resources necessarily to not only, comply with the multitude of rules and regulations that already apply to them, and then tack on this additional ESG related, this additional framework. So I think, and knowing that regulators are so sensitive to this subject right now, really, there's a risk involved in like stepping outside the bounds at all of what their expectations are and what your requirements are. So again, being consistent with all of your disclosures, needing to be hyper aware of what your disclosures are, of your reporting, making sure that things are updated, making sure that portfolio managers know what it is that they need to comply with. Same thing with marketing. You can't be going out there saying that your fund or your other product is doing something that it's not doing. Communicating, even the things like social media, like things that you post, like really needing to be careful about all of your communications. So those are the risks that I see as opposed to real investment related risks.
Kerry makes an important point also about investor expectations and the risks there. The reality is that the US has always been behind the EU in terms of ESG and regulatory considerations around ESG, but also investor expectations with and interest in ESG. And so there are surveys out there, very recent surveys, that show that, the interest in ESG considerations on the part of investors in the EU and in Asia is on the rise. Whereas in the US, it's actually trended down a little bit over the last year. And that's not to say that we here in the US don't value it, don't think it's important, and it shouldn't be an important part of a manager's strategy that either has that as an express strategy or is looking to access the US, the EU. It's just a fact that managers need to grapple with from a commercial risk perspective, an investor risk perspective, in terms of where they're looking to, in a challenging fundraising environment, maximize their ability to reach their targets for the fund that they're marketing, and do that, hopefully by accessing the EU, but balancing what they need to be cognizant of with respect to US investor expectations, which could be either investors that have an expectation for ESG with respect to the investments that they make. They could be neutral, or they could be, quite frankly, anti-ESG. And it's a careful balancing and walking of the line that managers need, especially in the mid-market, to be cognizant.
Yeah, if I just can add to that, fully agree with what you're saying. And indeed, what we are seeing is indeed more and more fund managers, because of the fundraising environment going cross-border, and especially for the mid-sized fund managers, they suddenly have to deal with SFDR. So obviously there's a big regulatory perspective to it, which we have been discussing most of right now. But indeed, to your point, there's also an investor demand from it in Europe and Asia, as you already alluded to. And what's interesting there is that we actually, within Holtara, we performed a survey. We surveyed 152 pension plans, public and private pension plans globally, focusing on the US, Europe, and Asia. And it's a 17-page report, and we can share it to the audience following this webinar. But there are two key takeaways that I can share is that pension plans continue to see ESG integration as a foundational trend, and believe that ESG investing can withstand volatile markets with pursuing long-term social benefits, as well as a good risk-adjusted return. I think that's something that the GP should understand, right? Like that's what pension plans are saying. But also, pension plans are becoming more focused on those asset managers who can really provide clarity on their strategy and their stance on ESG goals, and also show what they can meaningfully deliver. So it's definitely high on the agenda within the both public and private pension plans. But what you're also seeing more and more now is we see the whole democratization of the funds, and more, especially larger fund managers, trying to access, let's say, the more retail-like investors, but also from those type of investors, we're seeing an increase in demand of having funds that at least take ESG into consideration. And that's where you quickly come to, let's say, the SFDR Article 8 funds and Article 9.
Well,
Thanks.
What we also see is it's a certain condition that results into risks is the lack of access into data. So especially when it comes to the private sector, the private equity sector, there's no, you cannot really have access to this kind of information. So which will help you disclose under Article 3 when it comes to consideration of ESG risks, of sustainability risks. So you're not certain that you know all of these sustainability related risks that appear or will appear in the future, or disclosing under Article 5 of SFDR, which is the adverse impact of investment decisions. Again, access to data is key there. And then when it comes to Articles 8 or 9 compliance, again, there are certain investment managers that do not have the means or the access to such data, so they can perform according to investors' expectations. So this brings me to the next question, which is certainly linked to the collection of data. So Ed, how important is stakeholder engagement, including dialogue with investors, regulators, and other parties, effectively in managing ESG risks and opportunities for private market businesses?
Well, I think that we kind of addressed that in the last 10 minutes or so, but it is obviously critical. And I think going back to what we were talking about earlier, starts within the organization, and it starts with if you're talking about a mid-market or upper mid-market firm, it starts with the founders, and then it spreads out from there. But the tone has to be set, and the perspective needs to be set in first, but within the organization, and then with respect to investor engagement, it really comes down to making a hard assessment of what your existing investor and prospective investor target base looks like, and judging accordingly, whether you can guide your organization with respect to ESG considerations to meet their expectations. And you may not be able to for every type of investor. And that goes for the US and for the EU. As challenging as this fundraising environment is, and it is a challenging fundraising environment, you have to recognize that there's going to be investors that you're going to need to target, at a high level, and then at a low level or no level. So I think that's where it becomes the hardest for managers, because you'd like to be everything to everybody, but at the same time, going back to the thing we've said over and over, it's not really a cliche to say you need to do what you say and say what you do. And in the context of ESG, starting from within and then presenting it to your target audience is going to be key in terms of accuracy and fulsomeness.
Yeah, and Ed, maybe just to add there is within Holtara, we have a very large advisory team, and obviously a lot of the conversations with the fund managers here in the US who are going to Europe is about to understand they need their focus, what they're trying to achieve. Some managers, they are really they care about it, right? And that's really their philosophy. But we obviously also have managers who just went to Europe. They when they start fundraising there, they find out, oh wow, these pension plans in the Netherlands or Denmark, they actually do care about the ESG, and they need to suddenly comply with SFDR and other regulations. And then sometimes they come back to legal counsel and to us saying, okay, what do I need to do, and what is the bare minimum that I need to do to be able to comply? But that might fly from a pure regulatory perspective, but in practice, we're also seeing more and more LPs really looking. It's not just a check the box exercise. do you have an ESG policy and what type of fund are you? No, they're actually really reviewing the policies, right? And that also is being more and more, it is more and more important for GPs to understand, right? That LPs are actively looking into what you wrote down, and is it really part of your culture and strategy?
And now back to Katie. So, Katie, how do you usually help clients navigate through the complexities of ESG collection? Is there like a structure that you're proposing, or a policy?
Yeah, I think it's a wide variety of things. I think it certainly depends on the organization and their maturity and where we're starting from once we get engaged. But I think we certainly talk about gathering data, but I think gathering the right data is really one of the biggest challenges for companies right now, and even more so when reporting into something like the CSRD or SFDR, and even those companies expecting and engaging consultants and say service providers such as Holtara to assist in this process and the compliance with different regulatory requirements still need to gather and prepare their data in-house. So I think there's a lot of rigor required in terms of developing those internal, let's say, points of expertise and strategy and procedure that, yes, leverage technology, leverage consultants, but are also bringing in that rigor and continuity to the organization itself. So we certainly, as we've touched on throughout the conversation so far, it really comes down to dividing that clear ESG strategy, the approach, establishing the frameworks. That's where we would consider your foundational efforts, where it's really making sure that we have everything in place to then act on that data, gather it, and then also interpret it. But when it comes to the data itself, it really comes down to standardization. So looking to how you can standardize data collection, be it implementing protocols, leveraging those tools, really ensuring that's been done on a regular basis. So you want to make sure that you're doing test runs and practices ahead of those reporting deadlines, especially if it's going to be your first time reporting, because there's always going to be something that pops up towards the end where you thought you might have had something, but you didn't, or the data is looking a little bit different, so on and so forth. So we usually encourage doing a little bit of a test run or a practice, let's say, reporting effort where you're really going through the step-by-step procedures that you would require for the reporting deadline and the final output itself. But it's giving you that opportunity to, again, flesh out any, say, redundancies in the process, make sure that you have everything in complete and accurate presentation, so on and so forth. And with that comes ensuring data accuracy. So it's really about not only checking the box, but at the end of the day, it's garbage in, garbage out. So establishing those really good, rigorous internal controls that mimic what you would do for financial reporting, considering, let's say, third-party audits, internal audits relative to your internal audit committee to validate the data accuracy, which is really essential in terms of, again, this public reporting requirement and regulatory requirement. And I would say we're seeing it mimicked in the US relative to the voluntary or, let's say, non-regulatory compliance requirements, where it doesn't really matter. At the end of the day, if you're presenting data, it not only benefits, again, the public interest to make sure it's accurately reflected, but also your internal efforts. A lot of this data can be used for more than just this compliance and regulatory requirements, but really driving internal change across the organization, be it decreasing operational costs, increasing stakeholder engagement and employee satisfaction, so on and so forth. So there's just as much value to you as an organization to put this rigor into the data, to leverage it for broader purposes than just reporting.
I was leaving
maybe.
this,
sorry.
Yeah, I was leaving this for the end of the meeting as a kind of an Easter egg surprise. But as you mentioned, since you mentioned that the CSRD, Katie, so how do you see this impacting the reporting, and is there any synergies between the investment managers and the portfolio companies that may be in place?
I mean, absolutely. It's no surprise that ESG disclosure requirements are becoming more stringent, and LPs are certainly asking for more ESG data to adhere with these evolving regulatory requirements. And there's a lot of debate back and forth in terms of the value added from those data requirements or asks or different requests coming from the LPs to the GPs and also at the underlying portco level. And I think that's where there's a lot of opportunity for synergy, and where we'll see CSRD really come into place is that it may be new, but it's also already setting global precedent. So we're seeing a lot of that opportunity to require or introduce third-party verification for ESG reporting and metrics internally. And that's going to be a game changer when it comes to a lot of the different reporting requirements and regulation. And really governance comes down to the critical aspect here, where it's putting in those rigorous processes to allow for consistent communication, both with external parties, your investors, so on and so forth. And that comes in defining those roles and relationships in terms of structure and then even leadership and guidance. But some of what the CSRD is really providing is a different understanding of what this data is going to represent and where it's going to show up in terms of reporting, right? You have the accounting directive that's, again, requiring the annual management report inclusion. It's looking for uniformity across the financial and sustainability disclosures across the EU, and also requires that audit component. The transparency directive and some of what the amendments are creating is really to bolster a lot of the conversation around transparency and sustainability reporting, both on the listed side and unlisted requirements as well. Audits, as we mentioned, and then even again, the understanding that with SFDR, which we've been talking about more so here, I mean, the data that's going to be used to disclose with SFDR is coming from and relies on the data provided under CSRD. So there's a lot of intermingled, almost spiderweb-like connections to these data points and these regulatory requirements that really need to be put at the forefront and leveraged or capitalized more than I would say they currently are. We tend to think about them quite independently, and certainly they have their differences, but at the end of the day, they're all striving towards the same thing, which is making sure there's rigor in the data, consistency, transparency, and we're all really working towards a better planet for people, society, our economy, and again, the world at large. So I think there's a lot of opportunity for there to be conversations at the various levels of engagement and make sure that it's not just a check the box effort. It's not just a regulatory effort, but there's actual merit in terms of the why. Why do we need to provide this data point versus this? Is it consistent in terms of what we're being required for regulatory purposes? Is there a different way we can represent it? So on and so forth. So I think the rigor and the intent is really what it comes down to. And I think we've heard that throughout the conversation so far in terms of, again, understanding what ESG means to you as an organization and acting on that.
So an important point in our line of business is client management. So I will address this last question to both Ed and Mark. So how is it to manage clients when it comes to ESG, and is there a safe way for both asset managers and their investors to be satisfied with the ESG profile of a financial product they are launching?
Yeah, sure. I'll be brief because I know we're coming up on the hour. It's really a nice last question because I think it synthesizes what the overall message has been here. In particular for managers that need to think more rigorously about ESG when thinking about the EU. It means having a very clear and articulable sense of what ESG means to your strategy, what ESG means to your organization, and how you implement it. It also means then communicating that effectively, specifically, and in a way that is accurate based on what you've developed internally. It really comes down to that. And I think that if managers that take those steps will be meeting the expectations of the investors that they're targeting, and for those that are not going to be in their target audience, then as I had said before, that's a fact that managers need to be understanding that they're not going to be everything to everybody. And they're also, from a regulatory perspective, going to have an approach that will be, when they do sit down and talk with regulators, whether it's through an routine examination or otherwise, a strong foundation for meeting the expectations of the regulators that govern them.
Yeah, thanks, Ed. I think you said it very well. So I don't have much to add to that. It is indeed, to your point, that the type of investors you're trying to target and the locations where they are based, because obviously, as we all know, the EU consists of more than a few countries. It's a large environment, and supporting LPs within Holtara, we also see differences in LP demands, right, where they are coming from. And so pension plans in the Netherlands, they have a very different view, more stringent view than maybe investors from other jurisdictions. But I think very well said and very well concluded. So Adam,
yeah, this
nothing to
concludes
add
our
from my-
webinar, and of course, I think we will be all be interested to see any questions from the audience if there are any. I suspect Johan will gather the questions if there are.
Adam, at this stage, there is no question.
There's no question. All right. So
Apparently, we did an excellent job
yeah,
of not
don't
talking
be
about
a
everything.
Yeah,
okay.
I think one of the like this is a takeaway, right? It is a lot of people are hearing about ESG as a topic of the day, and then people interpret it in a different way. But in the end, it's something good, right? It's forward looking. And I think we didn't really touch upon it that much, but what we're seeing more and more as well is I think there was a Morgan Stanley survey, very recently published, and like 80% of the executives of companies that have a revenue of more than 100 million, they truly believe that sustainability will help them in creating value. And I think that's obviously important to the GPs as well as their LPs, is implementing a proper strategy on portfolio company level and looking how they have performed once you receive the data, and then making decisions into improving at portfolio company level will definitely help GPs increase and enhance the value of their portfolio companies, which obviously helps them once they want to sell the companies and increase the returns for the LPs.
Okay. So just making sure, Johan, there's no other question in case, there's no question at all. And in that case, we will close the webinar.
Yeah, thank you so much, Adam, for organizing, and the LPEA.
Yeah, thank you everyone for attending, and
Thank you.
yeah,
Take care.
minutes late.